Our next section is fundamental analysis. Fundamental analysis deals with methods of qualitative and quantitative analysis regarding reports issued by companies dealing with the current value of its holdings, or intrinsic value, and predictions of its future earnings. It should be obvious that fundamental analysis has practical importance, as the future earnings of a company will have an effect on both the size of paid dividends and on the growth of the market value of the company's stock. One purpose of fundamental analysis is to reveal whether or not the company's stock is undervalued, because if it is, most probably one could expect the stock to go up in price. However, there are other factors that affect this. Firstly, the effects of micro and macroeconomics are not the only influences on the price of stock. Market psychology can, to a great extent, have an influence. For example, a general dislike of a particular security by a wide circle of investors for no apparent reason can cause a profitable company stock to decrease in value. Obviously, such influences are very difficult to predict using some form of scientific analysis. Secondly, there is a so-called theory of market efficiency, according to which there are 3 degrees of efficiency. The first is weak. This is where only historical data is available for the market participants. The second is semi-strong. This is where the participants have access to public information, such as publications, news, etc., as well as historical data. And the third is strong. This degree comprises both weak and semi-strong, and further includes private information. The U.S. markets are considered to be between the semi-strong and strong degrees of efficiency. In contradiction to fundamental analysis, the theory of market efficiency assumes that all the securities in the market are traded at fair value. In other words, all publicly available information on a company is already incorporated or discounted in the market price of its stock. The theory suggests that the market discounts not only real facts, but also expectations, rumors, forecasts, and so on. As a result, any attempt made by a financial analyst to identify an undervalued security using this theory is doomed to failure. Despite the skepticism raised by the opponents of fundamental analysis, it is actively used by investors when choosing securities to include in a portfolio. The results of fundamental analysis are especially valuable for long-term and intermediate-term investments. For traders, whose horizon is limited to several months, weeks, or even day trades, technical analysis, which will be discussed in detail later, rather than fundamental analysis, is utilized. Fundamental analysis is conducted using 3 basic documents. The first are balance sheets. The second, income statements. And the third, cash flow statements. These documents are issued quarterly, Form 10Q, and annually, Form 10K, which the company must give to the SEC. There are also a large number of analytical reports prepared by independent agencies. The most popular of these are produced by the company's Value Line, Standard & Poor's, First Call, and Vickers. First Call publishes forecasts about future earnings of companies, and Vickers issues the reports about the trades made by insiders. Insiders are officials and directors of companies whose stocks are quoted on exchanges. An insider is also any shareholder owning more than 10% of a company's stock. At the demand of the SEC and exchanges, insiders are obliged to file special reports, Form 4, with an indication of all trades conducted. Now, all of this information is available via the Internet. The most commonly used websites for obtaining this information are Edgar. Edgar is an electronic data gathering, analysis, and retrieval system. On this site, the reports which public companies have registered with the SEC, Form 10K and 10Q, are accessible. The second are brokerage websites. For example, the web page of broker Charles Schwab, through which you can receive the various reports of different companies, including the Standard & Poor's, Vickers, and First Call reports. And the third are company websites. Usually at the site of a company, accounting documents of its activity are available. Now, we'll begin our review of the basic principles of fundamental analysis by looking at the first of three basic reports. Balance sheets are first. The balance sheet is a financial report showing the assets, liabilities, and equity of a company as of a certain date. The balance sheet has two parts. The left section refers to the assets, and the right to liabilities and stockholders' equity. Assets are the necessary resources for operation of the company, such as cash and its equivalents, inventory, property, and industrial equipment, patents, etc. The liabilities are credits, bank loans, etc. And stockholders' equity is the capital received from investors via the sale of company securities. As an example, let's review the balance sheet of Intel, issued in a quarterly report on September 27, 1997. The complete text of the report is given in the appendix of the course. The given balance is referred to as consolidated, as it takes into account all of Intel's affiliate companies or its affiliated group. An affiliate is one in which the parent corporation, in this case Intel, has at least an 80% holding. All the figures given in the balance did not pass an auditor's inspection. Therefore, it is appropriately referred to as unaudited. Now we're going to look at assets, or current assets. Current assets are those which can be converted into cash, sold, or used during a normal production cycle, as a rule within 1 year. They include cash and cash equivalents, short-term investments, trading assets, accounts receivable, this is the debt owed to the company, such as notes, and inventories, which consist of raw materials and works in process and finished goods. In addition to the items listed, different prepaid expenses, such as deferred taxes, are included in current assets. Fixed assets are those used for a period of time greater than 1 year. For example, buildings, vehicles, equipment, the industrial lines, etc. In Intel's balance sheet, the value of their property, plant, and equipment are listed, minus the accumulated depreciation, giving the net value. Also listed are the long-term investments and other assets. The liabilities of the company consist of the following items. The current liabilities include the short-term debt, accounts payable, what the company owes, deferred income on shipments to distributors, accrued compensation and benefits, accrued advertising, other accrued liabilities, and income tax payable. The non-current liabilities include the long-term debt, deferred tax liabilities, and put warrants. And the stockholders' equity includes preferred stock, common stock and capital in excess of par value, and retained earnings. As a note, retained earnings equals income minus dividends.